welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest this week is Seth Freudberg from SMB Capital. Before we get started, we have a disclaimer you see on the screen, also at the bottom of our web pages on our websites. Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss and trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And I got that disclaimer, a lot of it from the SMB disclaimer. So
I was going to say, I recognize that.
Yeah, so you have your own disclaimer, but I don't know if you have to go through much of it except maybe no relevant positions. So.
Well, yeah, that's right. It's if nothing else, we're great at disclaimers.
Great, so we got that down. So I've made you the presenter, Seth, and you made, for the people that don't know who you are or where you're at, maybe just a little bit about you and then screen and get going.
Sure. Okay, that's great. That's great. And so, Tom, I guess I'll take over the desktop, and I ought to know how to do that by now. So, yeah, hi, everybody. My name is Seth Freudberg. I started trading options about 8.5, I guess almost 9 years ago now. And I was an options mentor for a while. And then I took a day trading course up at SMB Capital up in New York. And while I was up there, we started talking about the possibility of SMB opening up an options trading desk. A desk basically means, an amount of capital set aside for a particular trading discipline, and then you hire traders into that discipline, into your fund. And then, you have a manager, and then you have individual traders. So they thought it would be a good idea. And so we started putting together the idea of an options trading desk. And in the midst of that, SMB asked, if I would put together a training program which would serve the dual purpose of acting as a training program that we could teach in general to anyone in the world who wanted to learn about options trading, and specifically a training program that we would put our traders through, particularly guys who, didn't know much about options. And so I developed that video series back in 2011, and we taped it in SMB's offices with an audience of traders. And then I guess, some months later, maybe, 12 months later or so, we actually launched our options trading desk. And today we have 6 traders on that trading desk. And almost everyone who's on the trading desk went through our options foundation program and some other advanced options trading courses that we've put together. And now they're trading with us. And I'll tell you a little bit, more later about how that works. And we're looking to grow that. And in fact, we're holding a trading contest that I'll tell you about if you don't know about it already, for folks who basically are interested in getting on our trading desk. And so we're running a contest to sort of see how competently people trade. And then hopefully we'll find a couple of good traders in that group and bring them onto our trading desk. It's a virtual trading desk, by the way. It's not, we're not all sitting together like day traders typically would. It's a virtual trading desk. In fact, I'm not even in New York. I'm in Philadelphia, and all the traders on our desk are in, only 3 of us are in the U.S. The other 3 are outside of the U.S., in Indonesia, Slovakia, and in Australia. And then we've got 3 guys here in the U.S., including myself. And, we're looking to grow that group. So with that, you can all see my desk. Is that right, Tom?
Correct. And by the way, Tony Sizemore said he wants to be in your trading contest.
Yeah, well, I know that. In fact, Tony and I had a phone conversation. I told him to just fill out the form, and then he can join. So I got to get Tony going on that, because it starts with December trades. I know his trades are a little bit shorter than typical, so he actually has a little bit of time, but he ought to get in soon. So did I see a chat comment, by the way, coming in? Oh, Paul Demers. Okay, Paul. At the end of the meeting, I'll give you my email, and then you can.
And I can put a link in the recording to your form too, or your email, so they can easily get a hold for that.
Super. Okay, that's great. That's great. So the only thing is you need to be a member of optionstribe.com, which is cheap. It's $30 a month. And then if you are a member, then you can participate in the contest. So we've got, I think, 32 people in the contest now, and as long as it's not too late for you to start a December trade, then you certainly could join the contest. So with that, I am going to start my presentation. And so this is to the distinguished members of CapitalDiscussions.com, which I assume is all of you. And you're going to recognize my next slide, which is, okay, if I can ever get to it, yeah, which is a very similar disclaimer. SMB Training is not a broker-dealer. We're giving these webinars for educational purposes only. Today's webinar contains no relevant positions, and you're going to see some hypothetical computer-simulated results, and you need to understand that slippage commissions and liquidity are all factors that affect your ability to trade, with the same kind of pricing you're going to see on the screen today, and so you need to be aware of that. Options trading is risky, so please be aware of those risks and don't expose any of your capital until you fully understand those risks. Okay, so with that, I want to talk today about how to become a professional options trader. And I guess this is one topic I'm an expert on, because I had to go through that whole process myself. And I was, I don't know if you know this, Tom, I was the CEO of a property casualty insurance company that ultimately went public. And, I knew literally what a call and a put was, and that's it. That's literally, all I knew. And so hang on one second, please. I am going to try to close my Skype. Okay, I'll do that a little bit later. So, thank you, Ray. I appreciate it. The only thing is, Ray, I think that's going to be a dead link. Ray put the Options Tribe contest link in there, but I think it's going to be a dead link unless you join optionstribe.com. So just everybody be aware of that if you go to that link. Okay, now, so, and I literally did not know anything about options trading other than what a call and a put was, and that was just definitionally. And I didn't know you could trade indexes and that kind of thing. And I just started from, scratch. So and then I started this trading desk from scratch. Everything I do lately is from scratch, and that's fun. Believe me, it's a lot of fun, and it's a lot of work, but it's mostly fun. So first question I think you need to ask is it possible to trade for a living? That's actually a very legitimate question. There are people out there who doubt that, but the fact is it is definitely possible. I know many people who do trade for a living. But the bad news is that most people fail. 80% of people fail, in fact, at trading. So why do so many people fail? And there's a bunch of reasons. And let me just tell you what, in my observation, has been the major reasons. Number one, they never take the process seriously in the first place. Tom, you remember you and I used to work for another mentoring service, as I'm sure you recall. And you might have, in fact, been the guy. Were you the one who assigned the mentoring students to the individual mentors? Each month, X number of people would sign up, and then they would get distributed to the various mentors.
Right.
And was that you?
I never knew that.
Yeah, I never knew who did the assigning. So anyway, and honest to God, it's still something I can't understand. 50% of the people never showed up for the lessons. They were entitled to, I don't know, like a bunch of mentoring lessons. They paid really good money for this. And half of the people never responded to our request to set up our first mentoring session. So they obviously, sorry?
The numbers I had were about 25% never had one mentoring session ever.
Right, right. I'm telling you, if more than 3 responded, I was shocked. If there were 6 people and 3 responded, that was sort of par for the course. And so, so if you don't take the process seriously, that's probably really the biggest issue. The second issue is people don't get educated properly, and they never find a mentor. And I don't know how you do this without a mentor. You can have an official mentor, an unofficial mentor, but you have to have someone who you can ask questions to, who can help you through the process, because it's not particularly intuitive. There's a lot of little things you got to learn. Another reason people fail is they actually experience some success with one particular strategy, so then they ramp up their capital massively. And my theory is there's an option god who's sitting there waiting for you to increase your capital on a strategy so that they can blow you up that next month, because it always seems to work that way. And then the next reason that people fail is they trade like a robot. They don't think, they just follow rules, and they don't think about the ramifications of what's going on. Paul Demers is saying he trades full-time, and he doesn't think most people realize how much work it is. Yes, it's work, and I'm here. I used to go and play golf in the middle of the trading day. I can't do that anymore. For one thing, I have a trading desk I've got to watch, and second of all, I'm trading more capital, so it's of much more import to me personally if something bad happens. And I just feel like I've got to be here watching my positions and watching everyone else's positions. And then another, these are all major reasons. I don't know that I could really rank them, but people fail to follow through on their plan because of emotion. You get scared. You make some kind of a silly mistake because you get emotional and you get scared. And that's a very, very big reason that people fail. Now, Ed Seykota said the easiest thing in the world is to develop a trading strategy. Is to develop a trading strategy that works. The hardest thing in the world is to actually follow it. Now, anybody who hasn't traded has no idea how that could be true, and everyone who has traded completely understands that comment. Yeah, you have to be willing to follow your plan, even if at certain times it feels risky or it feels scary. And that's just the way it is. That's just the way trading is. Some of you may have read a book called The Way of the Turtles. Has any of you read that book?
Yeah, I've read that. Seth, just real quick, you might want to move your participants and chat panels over to the right a little bit. You're kind of blocking your slide a little.
Oh, okay. I know you can't see that, but you could see what it was doing. Right. Okay. How about that now, Tom? That's better now, right?
Perfect. Yeah.
Okay, great. So it's the way of there's a book called The Way of the Turtles, and it's about these guys who taught some pretty talented people how to trade. And they found out that most people initially just didn't bother trading. They just didn't follow the rules. Even though they said, all you have to do is follow the rules. That's all we're asking you to do. We're not even asking you to make money. We're just asking you to follow the rules. Half of them couldn't do it. And yes. Okay. So in any event, that I had to turn my phone off. My apologies. And so, you plan your trade and then trade your plan. If it's a good plan, it's going to work over time. Next. Is there such a thing as a born trader? In my opinion, no. You can have certain personality characteristics. You may have a certain IQ. Those things are going to help you. But honestly, I don't think trading involves that much brilliant IQs and intelligence. I think it's more about discipline, more about getting your emotions under control, more about having an ability to absorb risk than it is, and you certainly cannot be a successful trader if you don't go through a serious process of education and mentoring, and then you just jump in. You will fail because you do not have the discipline, and you do not have the character traits necessary to be a good trader, in my opinion, if that is the way you approach it. So what's the proper path for trading success? And I've alluded to this already. You have to get an education. People who dabble never make it. You've got to get a mentor. I don't care who it is. It could be a personal friend. It could be a professional mentor. You've got to have someone to bounce ideas off of to right you when you're going wrong and so forth. What I think is critical to being a successful trader is to find your bread and butter trade. What that is different for everyone. I'm a very risk-averse trader, so I trade in a way where I have my Greeks under control all the time. Other people don't mind taking more risk and getting more rewarded for that. That's a different kind of trader, and for them, my bread and butter trades would drive them crazy, and they would never succeed, and their trades would drive me crazy, and I would never succeed. So you've got to find your bread and butter trade. The next thing is don't bump now. This is my opinion, that you should not increase your capital in a strategy until you've experienced at least one loss in that strategy. You've got to know what a loss looks like. You have to know how it feels to have that loss. Once you have that loss at a $50,000 capital level, and you can handle that, then a small increase in your capital level makes sense. But if you don't, and instead you get all excited about a strategy because you've had a 3-month winning streak on it, and then you bump your capital, that's almost always the wrong time to do it, because you're not going to know what can go wrong with that trade in many cases until it goes wrong, and you're not going to be prepared for that. So that's my opinion. That's what I advise my mentoring students. The next thing is trade. Don't just follow rules. And I remember one of my early good friends in the options world, and a good friend of Tom's also, Steve Channon, said, trade, don't just follow rules. Excuse me, his expression was, we're traders, we're not rule followers. And that's exactly right. You've got to use common sense in trading. Follow your plan 90+% of the time, but there are occasions where you can't follow strictly because of other factors that anyone with any common sense is going to recognize. And then trade a reasonable percentage of your own capital, or find a capital provider. That is really key. If you trade all of your capital, that's a great way to take a large fortune, turn it into a small fortune, because most people can't handle. It's not that you can't make money trading. You certainly obviously can. It's the fact that if you trade all of your capital, you will be so tense, you will be so emotional that you can't possibly succeed. So you have to trade either a reasonable percentage of your own capital or find a capital provider. And we'll talk about that, a little bit later. Now, and in fact, we'll talk about it right now. Trading for a prop firm. One way to find a capital provider. You can go to a friend, relative, et cetera, and ask them to put up some capital for you to trade. But there's such a thing as a proprietary trading firm, also known as a prop firm, and that's what, for example, SMB Capital is. And what we do is we give capital to people to trade, and then basically we do a split of capital, a split of profits. So we put up all the capital, you put up nothing. We take a look at your records. We probably are going to end up looking at tax returns even, or a broker records, and certainly a summary of your trading success. And then we are going to negotiate with you a split of the profits. You get one percentage, we get another percentage. There's an amount that's normally taken off the top called a desk fee or infrastructure fees or whatever. They're not usually very large, and as your capital level increases, they become less and less significant. Normally, people are started at modest capital levels. If you're an equity trader, they start you out with 100 shares or 200 shares or 300 shares per trade. If you're an options trader, we express it in terms of planned capital. So we'll start someone out at $100,000 of planned capital, and then we've got guys right now up to as much as $500,000 or $600,000 in capital, and increases most likely on the way. So that is one way to get capital. You can go to your uncle, you can hit the lottery, you can just trade your own capital if you have enough, or you can, and in my case, I do both. I trade my own capital, and I also trade SMB's capital. I do both, and that's another combination. You can sort of do a blend. You have to clear trades to a prop firm or its partners. When you say clear them, Stephen, does that mean get those trades approved, or do you literally mean clearing as in a clearing firm? Execution. Yeah. I'm not totally following what you're asking. If you could just kind of rephrase it, Stephen. The way it works with us is we have a trading platform. We use LiveVol, and Tom's familiar with that, and Jim Ridger is really familiar with that. And we use LiveVol, and LiveVol then executes our transactions through a broker, and ultimately the transactions are cleared through, hi Bruce, the transaction is cleared through our clearing firm, which is Goldman Sachs. So Bruce, I figured somebody was going to ask that. I'd rather ask that via email or a phone call, if you don't mind. So let's try to do that. At the end of the session, I'll give you my email address. I think you may have it anyway, Bruce, but I'll just double check. Okay, so and then yeah, so that is a way for you to get additional capital, and it's you know, the way to look at it is you can do both, trade your own capital, and for supplemental income, you could trade someone else's capital. And it works very, very well. Oh, great. Thank you, Bruce. Now, so next is just want to really quickly talk a little bit about SMB's fundamentals. And we believe that every trading discipline essentially has the same 7 elements that make people successful. And I've seen this happen. I was actually in the day trading class with the guys from some of the traders who are there today, back in 2010 when I took the course. Some of the guys there today were in that class, and the guys who did everything I'm about to mention succeeded. It's pretty amazing. And these are just common sense, almost ethical character issues. But I believe trading is more about character than it is about inborn intelligence, although obviously you need a little bit of intelligence. So let's talk about these. So what are the 7 elements? We'll just review them. Proper preparation, hard work, patience, a detailed plan, discipline, communication, and replaying important trades. So how does that apply specifically to options trading? Now, proper preparation. I have a practice that I've been doing for many years now, and I learned this one the hard way, that by 8:30 a.m. Eastern time, I am aware at the latest of what's going on the major index futures, the ES, the NQ, the TF, which are the major indexes that most people trade in positive theta options trading. So you got to know where those are, and you have to start planning how you will handle the likely open of the market, because as you know, the futures are oftentimes, most of the time, indicative of the way the market's going to open. The second thing is you've got to be aware of economic events each day. We've got something on our website, optionsdrive.com, which is gives you the economic events that are coming up in the future. You should, when you're planning your trade out, you really should be thinking about all of those events coming up and which ones are creating the most recent market movement. So be aware of those and trade accordingly. If you're trading individual equities, you've got to be aware of earning dates. I can't tell you how many people get into a trade and then forget that earnings is coming up the next day and they get blasted because of that. It's there's no excuse for that really, because you should have that kind of discipline. You should have alerts set on all your trades through your online brokers. And if you do go away from your screen, you've got to have contingent orders in on all trades if you're away from the screen. As our great friend, Tom's good friend, my good friend, Dan Harvey said once, and I love quoting him on this, and I think he's embarrassed when I do quote him on it. He says, the market can do whatever the hell it wants to do, whenever the hell it wants to do it. And so you think it's a nice calm day, and suddenly a bomb drops on, Tokyo, and, it changes everything. And so you can't make assumptions that because the day's calm and boring, that it's going to remain calm and boring. So please put contingent orders in as part of your preparation for your day. The second thing is hard work. And you cannot go into a strategy cold. You have to have at least paper traded it. I recommend that people back test strategies for 3 years before you can reach any conclusions about those strategies. And you need to paper trade those strategies for at least a month until you finally actually trade it, because if you don't, you're not going to understand the intraday ramifications of what you're doing. So the next thing is patience. You've got to let the market come to you, particularly upon trade initiation. Don't chase the market. If you're in an adjustment situation where there's a dire situation, of course, you're going to be forced every once in a while to chase the market. But when you have it, you know roughly as you become more experienced, what's a good fill, what's a good price to start your trade out, and you need to be patient and not chase the market. Let the market come to you. Especially when you're initiating, you have no risk until you initiate your trade. So that's the best time to be patient. So that's patience. Now, a detailed plan. Every trade you have should have a plan, and you shouldn't switch it mid-trade. I would say one of the major reasons that people make mistakes when they're trading is they are doing one trade at one point, and then they change their mind in the middle of the trade, particularly for illegitimate reasons, because, the market's selling off. Well, guess what? Every trade is designed to be able to absorb a certain amount of sell-off and a certain amount of rally. And so if you decided to enter the trade, using a certain plan, 90+% of the time you could stick to their plan. Now, the last point is that 10% of the time. Ralph Waldo Emerson said, foolish consistency is the hobgoblin of little minds. Now, I had to look up hobgoblin. Also, a hobgoblin is something that is an imaginary monster that you've fabricated in your mind, particularly children. Foolish consistency is the hobgoblin of little minds, meaning, remember, he didn't say consistency is the hobgoblin of little minds, foolish consistency. So here's your reminder. Foolish consistency is the hobgoblin of little minds. What does this mean? What it means is, if you're up, let's say you have a strategy and you're up 19% on that strategy and your target profit is 20%, okay? And the next day, an employment report that everybody who has any gray matter at all realizes is going to move the market because of the situation in the market. Everyone knows that particular employment report is going to be key to driving the market in one direction or another hard. You have to be sort of foolish to not take your trade off when you're up 19%. That is an example. And that's the kind of thing that's the difference between successful traders and people who trade just in a rule-following, robotic manner. So 90% of the time, trade your plan. 10% of the time, use your brains. And the next thing is discipline. Discipline's very important. Don't get ahead of the market. Don't assume you know what the market's going to do. Don't jump the gun on your adjustment points. Wait for fills at proper prices. Don't over-adjust. That's one of the biggest mistakes that traders make. They over-adjust. Just follow your plan. The best trading of the types of positive theta options trading that most of you do, the best trading is really do nothing most of the time. Why? Because we have a factor called theta that makes money, if we do nothing. So doing nothing is usually a very good idea, and doing something is something that should only be done when you have to. You never trade during the opening drive, the beginning, 15, 30 minutes, or try to avoid trading then. The pricing's horrible. The market makers know people are panicking. They take advantage of that. Try to wait at least 30 minutes to trade, if not an hour. Andrew Stanton's asking, hi, Andrew. Do you think the confidence to stay with your plan comes mostly from experience, either live or backtesting? I think the I think the answer to that, Andrew, is you got to back test to even think about trading something. To just go in blind because it makes a pretty picture on an analyzed graph is ridiculous. But the confidence to stay with, and I agree, both are important. The confidence to stay with your plan probably comes from a combination of those. I think the back testing actually, in my mind, is probably a little more powerful because you go through so many repetitions of it, and it's hard to have that level of experience, certainly in the early days. But eventually, the two experiences, I think, merge together. By the way, there's a study done. It was guys who imagined taking 100 free throws on a basketball court. There was one control group that just imagined shooting the 3 free throws, and then another control group that actually threw the free throws, and then they put them both out there. And the people who imagined the free throws actually did a little better than the ones who had the actual experience of the repetitive free throws. So just even visualizing something scientifically is virtually the same as experiencing it. So I guess it depends on the person, Andrew. I think both are very important. Next, communication. Okay, I'm biased here. I say attend options tribe meetings. You know, Tom, I should have added or capital discussions panels. Okay, I should have said both. That wasn't very nice of me. So I take that back. But
it could be any regular meetings that you're talking about options. It doesn't have to be either one of ours. It could be just anything you're getting together with other traders and bouncing ideas around.
Exactly, and it's important to participate in a community of some sort. It's very important, really, because you need a lot of options traders are sort of in a vacuum. Even guys on our trading desk, some of them feel like, I've never felt I was in a vacuum for some reason, but a lot of people do. And so you need to be part of something to bounce ideas off of other people. So capital discussions is one way. The options tribe is another way. There's lots of different ways. Another thing is to when you see a concept, fool around with it. Today I was just working on something new. I'm always working on new stuff. I happen to be fascinated by options. I just love it. And so I'm always coming up with new stuff and always coming up with new ideas. And that's how you deepen the experience of communicating with others. On optionstribe.com, by the way, we have a members chat. It's free to anybody, actually. You don't even have to be a member to get involved in our chat. And I'll show you that a little bit later. Okay, now, next. Trade reviews. If you have had a losing trade, this is so important. This may be my most important slide of the day. If you have a losing trade, it is so important to go. The winning trades, honestly, I think reviewing them is not that important because basically you knew the plan was going to work and it worked, okay? When you have a losing trade, there's only two reasons you lost. Either you screwed it up, you traded it wrong, or it is one of the months where that strategy cannot handle that kind of market, okay? I would say at least half the time you screwed it up. And you all know what I'm talking about. You say, if I had only left the darn thing alone, it would have been fine. Instead, I tinkered with it, and I ended up losing. This practice can teach the significance of avoiding emotional adjustments and also may surface alternative ways to handle trade circumstances through experimentation. So, go back. A lot of times a student will say, I lost money on my whatever, heart-friendly butterfly that month. And I'll say, let's see what you did. And we'll go into the strategy. And then I would say more than 50% of the time, they traded it wrong. They waited too long to make an adjustment. They made an adjustment too early. They got mixed up about a rule, something. And then you can trace, by the way, most of the time I find the reason why trades go badly is because people start them wrong. That's a major reason. They just initiate the trade wrong. And if you do that, you're starting behind. And then sometimes you never catch up. Okay, now, Tom, I'm admitting now to plagiarism. but at the same time, I'm not. Tom, you there?
Yeah, I'm here.
Yeah, okay. So we all know that Dan Harvey invented the weirdor, and I developed some time ago. I was actually on vacation, and I just had this idea in the middle of the night, and I woke up and started back testing it, and it worked pretty good. It's called the speeding train iron condor. But I've now revised it to the speeding weirdor. Now, okay, and I'm basically doing this for fun because, you know, we come up with really strange names in the options world. Everyone, yeah, backtesting a vacation, now that's dedication. It's more obsession, Stephen, than it is anything else. But yeah, I got this idea and I just got so excited about it. So anyway, so this is basically it's basically the speeding train strategy, but it involves a little tweak that I really basically stole from the weirdor idea, and so I'm admitting that up front, but I think it's got a lot of potential. Yeah, John is saying obsession, psychosis, 6 of 1. That's correct. That is correct, John. Exactly. It's both. My wife, you know, they can't believe I'm still into this after all these years. Okay, now, so what is the premise of a speeding train? Let's just talk about the speeding train iron condor first. The presence of the speeding train, the premise of it is that, just think about it. When we talk about 10 delta shorts on our iron condors, we say that has at least a statistical 80% chance of winning, because the delta is also the probability of that particular stock or index ending putting that option in the money on expiration day. So 10 delta shorts on both sides of an iron condor means there's an 80% statistical probability of that option expiring worthless. Okay, so instead of fooling around with an iron condor, why not leave it alone? And the answer that most people will give you is because as they start to turn ugly, they turn really, really ugly. And so they roll the troubled side away from the market. But the problem is that when you're doing that, you're going to have to spend so much money to do that roll that you hardly have any credit left. And any of you who traded iron condors knows exactly what I'm talking about. With the speeding train, you do the opposite. You add capital when you're in trouble. You don't subtract it. And why? Because when you're down money, you get paid more money for the additional capital. Now, that's not quite an totally accurate way of describing it, actually. It's not that we're adding capital when we're in trouble. It's just we're not adding all of our capital at once. Any of you who've traded iron condors know that 75–80% of the time, when you enter into the iron condor, you are down at one point or another during the trade. That, to me, is the perfect time to add capital because you will get paid a larger credit. By definition, if you're down money on an iron condor, it means it's trading at a higher credit at that point. So let's just take a look at a simple example. And there is a guy on our trading desk, by the way, who trades similarly to this, not quite exactly this, but this basic principle. So what we do is we take 25, let's say you're going to do a 100-lot iron condor in the Russell 2000. So this trade starts 60 days out. And these are just general ideas. You obviously don't have to trade exactly this way, but this was the way the trade was designed. You start under 10 delta in both cases. You can see I've done that. And this was August of this year. And so we have a 1050, 1040 put credit spread, and we have a 1240, 1250 call credit spread. And that would be the initiation of the trade. And instead of rolling when the deltas of one of the shorts gets high, we're not going to do anything. We're going to actually add capital every 7 days. So the next time period, can't see the top of the slide, Seth. How about now? Now can you see it? Okay, great. Yep. So in the second, what I call tranche, you add, which is a week later, day 53, you add your second, no matter what the market's doing, no matter what the deltas of your shorts are, you're going to add at the exact same level. And then this is deja vu all over again. We're doing it again. We're doing it a third time, right at those same strikes. And here you can see the call side is getting a little scary here, and not very scary, but it's getting a little bit scary. But we're going to go in and just add anyway. The trade's down money, meaning we're going to get a higher credit for this one. And then finally now at this point we sort of lost the bet. The trade was actually up money, so in this case, adding actually was a negative at this point because, or I should say, our having waited to apply the capital for this particular add point was not as good as having actually added at the beginning. But in any event, according to the technique, you add your fourth tranche 21 days after your original 25 lots. So now we've gotten up to 100 lots. And then I wish there was some music, because now it's up to the options gods. In case you were wondering, these are the people who, as soon as you adjust your trade, they send the market the other way. In case you were wondering, this is what they look like. Anytime you roll out of trouble, the market will start reversing, and if you had just waited another 5 minutes, then you wouldn't have had to adjust. These are the people who do that to you, just so you know. This is what they look like. Now, so basically, the strategy is your target profit is 75% of the credit that you've received, and your maximum loss is 20% of the gross margin. What's the other term that's used for that? What's the term that option uses for that? Yeah, gross requirement of the trade. So those are your. So if you get a really big credit, that number 75% could be 10% of the gross requirement, or it could be 11%, or it could be 9%. But that is your target profit. Now, another aspect of any competent iron condor trading is to close those sides that are, now let's take a look at what happened. We're going into September 16th. This is before the big sell-off in October, and you will see that although the market had sold off somewhat apparently, so you can see here that this side of the trade had gotten down to a dime. Once we get to a dime, then the risk is huge and the reward is minuscule. So in any investment or trading strategy, when your risk-reward trade-off is out of sync, that is when you deal with it. And so what we're doing here is we're closing that side. Now, as it turns out, that actually would have been unnecessary in October, and actually would have been cost us money, but we're being prudent traders and we're not looking back. So now we're up 69.50. Now, at this point in the trade, the upside risk is gone. The upside risk is gone. So I personally am uncomfortable whenever I basically am not neutral. And so I like to have, and that's the thing I do not like about taking a cheap side of an iron condor off, because it still was providing some protection, and now you have no protection against a down move in this case. So what this new element of this speeding train iron condor technique is to borrow from the weirdor concept, and at this point in the trade, go ahead, when we reach 75% of target, of the credit, we add long calls or puts right above or below the market, as the case may be, locking in that 75% of the credit target. So this creates a situation where once you've done that, the upside still is without risk for you, basically. You will make money on the upside, but what it does is now it actually creates a situation where you can make money if the market goes against the side that you would normally hope it would not go against. And that is because you have bought the weirdor-like long call or long put right below the market. So in this example, the market was trading at 11.57, and so at the 11.50 strike, we bought 3 puts. Now, that is going to lower our theta. It's going to cost us money. It's permanently going to reduce the potential that we can make on the trade if the market keeps rallying, if the market were to rally. But now the downside, instead of it being just a bummer if the market sells off, the downside is now creates a positive potential. So Tom, I am sure you recognize that analyze graph. It looks very much like a weirdor. And essentially what we've done is we've kind of created a weirdor, but we've done it in the middle of the trade, and we've done it once we've taken off one of the sides for a profit, which almost always happens. And now you have that other side. And now you can have fun because you've locked in a very, very nice profit of 72.63 here. But if interesting things happen, you can actually make a lot more. And that is if the market basically what starts happening is the puts, the long puts start having their own value, but the credit spread, because of time, keeps shrinking. So it becomes a race between the value of the put, in this case, and the shrinking of the credit spread. And if things turn out just right, the market keeps selling off, but the credit spread starts running out of time to have value, so it starts shrinking, and then you can really, really hit a home run. And when it happens, it's really worth it. And so let's see what happened next. As you all remember, in early October, the market had a really scary sell-off. A lot of key points started to break down. In early October, everyone thought, here we go again, another bad October. And look at what was happening. Those three, remember, we had locked in $7,200 to the upside. To the downside now, we're already up $12,000 because those puts, which can you see here, we paid $19, and you can see my cursor, right, everybody?
Yep.
My mouse, yeah, $19.45 we paid for those. Now each of them is worth $50.60, so that's a bunch. So what's happening here is as the market's selling off, these puts are really starting to take off in value. Now these guys are getting hurt. This short is getting hurt by this, although this long is getting helped by it. But still, and the overall spread is not in horrible shape. It's down money. We entered it for 68 cents. It's 95 cents. But basically, this race between the expiration of this credit spread and the increased value of the put, those two factors are in a sense in conflict with each other, and that conflict is making you money. Now, so now I want you to see at one point here. Remember, our max loss is 20,000. At one point here, the trade, and by the way, I allow the speeding train to go into the short strike. What kind of a condor do you ever see where you let the short delta get to 51? The delta of the short strike. When do you ever see? You never see that happen, right? But in this case, we had on our long puts. Now look what happened. They have quintupled in value. And so even though you're getting killed on this credit spread, it's not that serious because these puts got so powerful that now we're down money, but we're not down money a lot. So I would personally have stayed in the trade at this point, even though we've now pierced the short strike. And this obviously is a cool example. It's a great example, but look at what's happened and this is when the market's rallying. So the puts started losing value, but they still had tripled in value. And now your credit spread's down to a nickel because there's 1 day left. And so there's just not enough time for the market to come in and take out that final amount. And so you would have made $25,000. So basically, you took off your call side, and then you made a small fortune on your puts, even though the market went against the side that was exposed. And that's pretty cool, and that's something that the weirdor does. Would exiting at the peak of the T+0 line be a good plan? Well, Andrew, if you can do that, yes, I think that is a good plan. You can see when you're in these trades, you can kind of see it kind of cries out at you when you should exit, because you see that you've tapped out the value of the puts, and the credit spreads are running out of time to get value. There's this kind of like sweet spot where the puts are at a very high value, and the credit spread is starting to die, and that's when you don't want to lose the value in the puts, and the credit spreads, you're not going to get much value out of them anyway. So that's a really good time to end the trade. So it's a very interesting technique, and it really was, my good friend Dan Harvey taught me the Iron Condor, and now he taught me a really interesting way to modify the trade. So that's just an idea of the kinds of trades, the kind of the theme of trades that we do on our trading desk. We do lots of other things on our trading desk, but this would be an example of a kind of certainly we do Iron Condors on the trading desk, and we use long calls and long puts to manipulate those trades. So for anybody interested, and I think I've mentioned this before, the Options Tribe trading contest is actually underway, but if you have a trading style where there's still time for you to put on December trades, you can shoot me just your email address. You do have to join optionstribe.com. It's pretty cheap, $30 a month, and then you can be part of the contest, and we'll show you. You've got to learn how to use OptionView if you don't already, and then we've put all of our trades into a shared drive in OptionView, and then all the traders can see each other's trades, which is very, very valuable. In other words, every trader, there's an account for each trader, and every trader can look at every other trader's trades, and you can learn from it. And that's what this is all about. Yeah, the winner's going to probably get a chance to trade on our trading desk if I get it approved, and I feel comfortable I'm going to. But more importantly, it becomes a learning experience for everyone in the contest. So as I say, the way the trading contest works, you've got to trade at least $10,000 of capital. You have, we're going to be measuring the period December 2014 through May 2015. That's a typo. And you can do multiple strategies. Weekly and monthly strategies are fine. And then you'll enter your trades into OptionView. We have a deal with OptionView where we get a 6-month trial for anybody in the trading contest. And so you have to let us know you're involved, and then we'll get you over to the link, which gives you the ability to sign up for the trading contest. We're going to be measuring returns in a number of ways: total return on capital, the Sharpe ratio, return divided by maximum drawdown. I'm going to be looking at risk management and discipline, what your decision-making processes were, and of course, diligence and hard work. Now, the winner will be recommended by me to the management of SMB to trade on our trading desk. I've never had them turn me down once. But again, they do have the right to approve any traders I recommend. So we're going to be putting together a leaderboard that we're going to post on optionstribe.com for paid members, we will, it looks like everyone wants to be anonymous because everyone's giving me a nickname. We've got some really strange nicknames, by the way. One of them is the Eyebrow Farmer. I can't understand what it means. He tried to explain it to me. We have a guy named Maximus, Eyebrow Farmer. We have ZZ Butterfly. What else? Anyway, we've got some great names, and we are really excited about our contest. Now, if you'd like to join the Options Tribe, you go to optionstribe.com. You click on the join tab, as you can see, and then it will lead you there, and you can see our chat there on the side. We have a chat, for members. So we also, if you don't know anything about options, I kind of doubt anybody in here doesn't know much about options, but we do have our Options Foundation program, and we've really cut the price down so you can take the first piece of this for, oh, Dave, how do you look at other people's trades? In Option View, if you go in, you just click on the other accounts and you'll see all the other trades. It's not on the main Options Tribe website. It's within Option View itself. We do also have our advanced strategies. We call it SMB's Option Strategy Series, the Heart Friendly Butterfly, all of John Locke's stuff, the M3, the Rock, the M21, Bearish Butterfly, and various other strategies. Broken Wing Butterfly is also very popular, so you might want to check those out. And you go to all those by smbu.com. You click on the Programs tab, you press on SMB Options, and then you find the strategy that you're interested in. So here's my email address. Anyone wants to join the trading contest or you have any questions about any of this, love to hear from you. And thank you for your attention today. Yeah, okay, Dave, we'll work on that. I don't know why you're only seeing your accounts. There's something wrong, and we'll straighten that out. So, sorry?
It went for 6 months?
It runs from, it's trades with expirations of December 2014 through May 2015. So for example, let's say you trade weeklies, you may not get started until a week or two from now, and you'll start trading December weeklies. Or you may do, a 65-day iron condor, in which case you probably started in October.
And is the Option View trial available to people who already own Option View?
No. No. I don't think so. You mean, how would that work? In other words, no, it's only for people who do not have Option View.
Okay, just want to clarify that.
Yeah. So, great. Well, I'd like to thank everybody. Did you have any other questions?
That looks like it. Really appreciate you coming on, Seth. We can certainly do this more in the future if you like. It's fun to see you, and I'm sure everybody else enjoys it too.
Well, it's my pleasure. I'd love to come back, Tom. You know, you and Jim are good friends, and you both presented on the Options Tribe, as a matter of fact, and we've known each other for many years. I'm more than happy to come back at any time. Thank you, Stephen. I appreciate your comment, by the way.
Okay, well, I think we're right at an hour, so it's a good time to stop. So thanks again, everybody, for coming, and Seth especially. And we have Amy Meisner coming on next week. Seth, you might be interested in that.
Oh, I better come. Yeah, I want to see Amy.
Okay, great. So thanks again, everybody, and we will see you next week.
All right, take care. Good night,
All right,
everyone.
Thanks. Bye.